7 days ago, I sold all the world index shares that I owned and bought Footsy 250 shares. And this was by far the largest ETF I was holding. So this was a big move for me. So why? If you hadn't heard, there's a general election coming, or as my daughter calls it, a Jenny Leck. And Labour will win a massive majority. So let's have a look at one of their specific policies. In its manifesto, Labour said that it will act to increase investment from pension funds in the UK markets by adopting reforms to ensure that the workplace pension schemes take advantage of consolidation and scale and to deliver better returns for UK savers and greater productivity investment for UK PLC. So what I take this to mean is the pension administrators of schemes across the UK will be incentivised to invest their funds in British companies listed on the London Stock Exchange rather than the US stock exchanges. This would generate an inflow of capital into the LSC, which would in turn hopefully see an increase in some of the stock prices. I do have my doubts actually whether this policy would actually work in practice, but I do think that the promise within the manifesto may see some upward pressure on stock markets, particularly in the Footsy 250. So I moved my shares across 7 days ago. So how have they done in the last 7 days? Well, actually, both indices have done exceptionally well, both just around the 1% mark. So if you could, you shouldn't, but if you could extrapolate that over 52 weeks, that would be a 52% increase. So as I say, both indices have done excellent this week. So whenever I make a big decision, such as moving lots of my stocks around, I'll have an idea as to why it's a positive move, but I'll also always have a really good look at what the opposite news is saying. So what's saying that this is a bad idea? And there has been some news that came out yesterday, actually, which means the UK is not looking great as a place to invest. So let's have a quick look at that. So one indicator of whether a country is doing well or not would be the number of high wealth individuals, the number of millionaires who are moving in or moving out of a particular country. So this is an article that was released yesterday, and it talks about the potential loss this year of 9,500 millionaires outflowing from the UK, with only China having a worse statistic. So that's a lot of influential people with lots of information about the economy, and they are making a decision to leave. Not a great indicator if we are looking to invest in the London Stock Exchange. And whilst I was producing this video, Patrick Boyle has just released a video talking about the same issue. I don't know if you've listened to Patrick Boyle, but he's well worth a listen. Excellent YouTuber. So whilst we have some positive news about the Labour policy to encourage investments in the London Stock Exchange, this should definitely be viewed within the context of the huge number of millionaires who think otherwise about the future of the UK. And if I were you, I wouldn't make any kind of decisions of this kind without speaking to a financial advisor to see how it fits with your situation. There has been another factor that's influenced my decision though, and that is the extremely strong performance of the All World Share Index, which is up 15% over the last 12 months. So huge increase there. And I do worry that it, having already had such massive increases in 1 year, does it have anywhere still to go? In fact, even in just the last 6 months, there's been almost a 13% increase. So this is the primary reason that I've moved my investments across. Over the last 8 years, the Footsy hasn't performed nearly as strongly as the All World, but things may be about to change with this change in the rules introduced by Labour. Let's have a look at investments in the UK over the last 8 years. So here's a chart from the Office for National Statistics. The red line shows the trend from 2009 up to 2016, and then continues as if things hadn't changed. However, in 2016, there was a lot of uncertainty in the UK economy based around the Brexit referendum. Since then, we've seen a number of UK companies actually ignoring the London Stock Exchange and listing themselves on the US markets. A boost to the London Stock Exchange would be very welcome as far as I'm concerned, but I'm not sure forcing pension funds to invest in the market will actually work.
So if you've heard my outro, then thanks for listening. And if you haven't, then here's probably the most important bit of investing advice you'll hear on YouTube. Don't buy or sell shares in a company based on what someone on YouTube tells you. The big Wall Street analysts have large teams of professionals with access to vast amounts of data on every single listed firm. There are no YouTube gurus who know better than them. Use YouTube to find interesting bits of information on companies that you may otherwise miss. And when you find something interesting, do your own digging and see what the analysts in the big firms are saying. Never invest more than you can afford to lose, and don't expect to get rich quick. If you are interested in my background, I come from 16 years in risk management with PwC and Deloitte. I've never been on a trading floor in my life, but if I had, it wouldn't give me the edge on the big firms because they have big teams and masses of information. So don't look for a guru with an edge. Look for information on companies you're interested in. And if you're looking to invest a large amount of money, don't put it on individual stocks. Choose an index fund. The All World Index is a representation of all the stocks in the world. And if one company goes broke, then the index won't even move. Whereas if you've only invested in that one company, then you may have just lost your pension. Keep it fun, keep it affordable, and subscribe to keep getting my updates. Thanks.